Welcome to Alpha Insights. I'm Gareth. Today we're digging into the latest in the cannabis sector. Some relief in New York, but continued headaches in places like Colorado and California. With me is Josh, our market historian who loves to connect policy moves to investor outcomes. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Great to be here, Gareth. There's a lot to unpack. This felt like a day where policy headlines did the market's work for it, more than earnings or big corporate news.
Let's start with New York. Josh, what changed and why does that matter for retail operators?
New York passed a zoning tweak that basically expands grandfathering protections. In plain English, that means more retailers who were at risk of being forced to close because they were too close to schools or churches can stay open. For operators with stores in New York, that removes a clear, immediate threat to revenue. Fewer surprise closures, more predictable cash flow.
So that's short-term relief. But Colorado's story looked rougher today. Walk me through what the memo said.
Colorado officials put out a memo showing marijuana tax receipts have been drifting downward over the past 5 years. That doesn't necessarily mean total demand vanished. It signals that the market is fragmenting. More states have legalized, so consumers are spread across more regulated markets. Also, non-traditional products from hemp that can get people high are pulling share. The big takeaway? Early adopter states can see revenue erosion as the national landscape changes.
That idea of market fragmentation is important. From an investor's perspective, what does falling state tax revenue imply about margins and business models?
It points to margin pressure at the local level, especially for operators that leaned heavily on one state for sales. If a company relied on Colorado tax-heavy pricing or a captive consumer base, they now face tighter margins or slower growth. For investors, it raises the premium on geographic diversification and on companies that can pivot product mixes to compete with these new hemp-derived options.
We also heard from the federal side today. The FDA head made some comments. How should we read those?
The message was balanced. The FDA head acknowledged there are medical benefits to marijuana while also flagging concerns about youth exposure and safety. That keeps the door open to regulatory progress, even rescheduling, but signals any change will likely come with safeguards and restrictions. In short, federal progress may be gradual and conditional rather than an immediate free-for-all.
And then California got a bit of heat from industry coverage. What's the risk there?
A high-profile piece criticized how policy and certain business practices are hurting California's cannabis economy. California is the largest U.S. market, so when regulation or industry behavior undermines growth there, it influences pricing, supply dynamics, and investor sentiment nationally. If California doesn't stabilize its regulatory framework, or if compliance costs stay high, companies with heavy exposure there could lag.
Given all that, which names should listeners be watching, and what metrics matter most in the near term?
Keep an eye on flows into the big U.S. cannabis ETF. That tells you where passive money is going. For companies, watch Trulieve, Green Thumb, Curaleaf, and Tilray. Those are among the large public operators with different state footprints. The key metrics, same-store sales, store counts, state-by-state revenue splits, and how exposures line up with tax or zoning risks. Also watch state tax receipts and any formal federal guidance on rescheduling from agencies like the FDA and the Department of Justice.
If you were advising an investor right now, what practical steps would you recommend?
Be selective. Favor operators with diversified state footprints, clear retail strategies, and manageable tax or regulatory exposures. Pay attention to trading volumes and ETF flows for momentum signals. Avoid overpaying for headline-driven stories and focus on companies that can adapt product lines as hemp-derived products grab share. Finally, watch federal statements closely. A real rescheduling move or even strong guidance could reprice the whole sector.
Great. To wrap up, give our listeners 2 or 3 quick takeaways.
Sure. 1. New York's zoning change is a real near-term positive. It removes an immediate closure risk for more than 150 dispensaries. 2. Declining Colorado tax receipts don't mean demand disappeared. They show the market is fragmenting and competition from hemp-derived products is real. 3. Federal comments recognizing medical benefits keep rescheduling hopes alive, but protections for youth and safety mean any change will probably come with strings attached.
Excellent. Thanks, Josh. And listeners, if you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. For more market insights, head over to stockalpha.ai.